Hello and welcome back. I am glad you are here. Today we are tackling a topic that every single veteran homeowner needs to understand. We are talking about refinancing, but not just any refinancing. We are talking about the VA Interest Rate Reduction Refinance Loan. You have probably seen the acronym. It is IRRRL. Most people in the industry just call it the Earl. It stands for Interest Rate Reduction Refinance Loan. Here is the hook. Here is why you need to pay attention right now. Imagine lowering your interest rate without the mountain of paperwork you dealt with when you first bought your home. Imagine dropping your monthly payment without having to prove your income all over again. Imagine doing this without an appraisal. That is what the VA ERRL offers. It is designed to be fast. It is designed to be simple. And it is designed to put money back in your pocket. But, and there is always a but, you have to do it the right way. If you do it wrong, you could end up paying thousands in unnecessary fees. You could end up resetting your loan term when you shouldn't. So today, we are going to break it down. We are going to strip away the jargon. I want you to walk away from this episode knowing exactly how to use this tool to build your wealth. Let's start with the basics. What exactly is an IRRRL? Think of it as a streamlined refinance. The Department of Veterans Affairs wants you to stay in your home. They want you to be able to afford your payments. So, if interest rates drop below what you are currently paying, the VA makes it very easy for you to swap your old loan for a new one at that lower rate. The beauty of this program is its simplicity. When you bought your house, remember the stress? You had to dig up W-2s. You had to find bank statements. You had to explain that random deposit from your grandma. You had to wait for an appraiser to come out and pray the value came in high enough. With the IRRRL, most of that goes away. Why? Because you already have a VA loan. The VA already guarantees your loan. You have already proven you are a good borrower by making your payments on time. So the VA says, okay, we trust you. Let's make this easy. In most cases, there is no income verification. You do not need to show your pay stubs. You do not need to show your tax returns. This is huge for veterans who might be self-employed or transitioning between jobs. As long as you are making your current mortgage payments, you are generally good to go. And here is the kicker. No appraisal. Let that sink in. No appraisal. This is massive. Maybe the market has shifted. Maybe your home value has fluctuated. It does not matter. Because this is a benefit for you, the veteran. The focus is on the payment, not the equity. You could be underwater on your loan, meaning you owe more than the house is worth, and you could still potentially use an IRRRL to lower your rate. That is a safety net that almost no other loan type offers. Let me give you an example. Let's talk about a veteran named Mike. Mike bought his house a year ago. Rates were high. He locked in at, let's say, 7%. He could afford the payment, but it was tight. He was paying $3,000 a month. A year goes by. The market shifts. Rates drop to 5.5%. Mike gets a letter in the mail. It says he can lower his rate. Mike is skeptical. He remembers the nightmare of closing on the house. He doesn't want to go through that again. He doesn't want to pay for an appraisal. He doesn't want the hassle. But Mike calls a lender who specializes in VA loans. The lender tells him about the IRRRL. The lender says, Mike, we don't need to appraise the house. We don't need your tax returns. We just need to verify you are currently employed and look at your mortgage payment history. Mike moves forward. He drops his rate from 7% to 5.5%. His payment drops by $400 a month. Think about what $400 a month does for a family. That is groceries. That is a car payment. That is money into a retirement account. Over the course of a year, that is nearly $5,000. Mike did not have to jump through hoops. He just used the benefit he earned. However, while the process is simple, the math needs to make sense. And this is where people get tripped up. Just because you can refinance does not always mean you should. You have to look at the costs. Yes, there are costs. This is not free money. There are closing costs involved in an IRRRL. There are lender fees, there are title fees, and there is the VA funding fee. For an IRRRL, the funding fee is significantly lower than when you buy a home. It is usually just 0.5% of the loan amount. So, if you are refinancing a $400,000 loan, the funding fee is $2,000. Most veterans roll these costs into the new loan. This means you do not pay them out of pocket. You bring $0 to the closing table. This sounds great, right? No out of pocket. Lenders love to say that. No out of pocket expense. But please understand this. No out of pocket does not mean no cost. It means you are adding those costs to your total loan balance. You are financing the fees. You will be paying interest on those fees for the next 30 years. So you have to weigh the savings against the cost. Let's go back to Mike. Mike is saving $400 a month. Let's say his total closing costs, including the funding fee and title fees, come out to $5,000. Mike adds that $5,000 to his loan balance. Is it worth it? We do a simple calculation called the break-even point. We divide the total cost by the monthly savings, $5,000 in cost, divided by $400 in monthly savings. That equals 12 and a half months. That means in just over 1 year, Mike has paid for the cost of the refinance with his savings. Every month after that, the $400 is pure gain. That is a home run. That is a no-brainer. But what if Mike was only saving $50 a month? $5,000 in cost, divided by $50 in savings. That is 100 months. That is over 8 years. If Mike plans to move in 3 years, he should not do that refinance. He would actually lose money. This is the nuance. This is the detail that predatory lenders will hide from you. They will focus on the fact that you skip a payment or two. They will focus on the no out of pocket. They won't walk you through the break-even math. I want you to be smarter than that. I want you to look at the numbers. Another important aspect of the IRRRL is occupancy. To use an IRRRL, you only need to certify that you previously occupied the home as your residence. Notice the difference? When you buy a home with a VA loan, you must intend to live there. It has to be your primary residence. But for an IRRRL, you just have to prove you lived there at some point. This is a secret weapon for building an investment portfolio. Let's say you bought a house at your last duty station. You lived there for 3 years. Then you got orders to move. You decided to keep the house and rent it out. Now rates have dropped. You want to refinance that house to lower the payment and increase your cash flow from the rent. Can you use an IRRRL? Yes. Yes, you can. Even though it is now a rental property because you used your VA entitlement to buy it and you lived there previously, you can use the IRRRL to lower the rate. This is huge for accidental landlords or veterans building a real estate portfolio. You can lower your overhead on a rental property with a streamlined low-doc loan. Conventional investment property refinances are expensive. They have higher rates. They require tons of paperwork. The IRRRL bypasses all of that. So you have this powerful tool, low documentation, no appraisal, ability to use it on properties you used to live in, but you have to be careful about churning. Churning is when a lender convinces you to refinance over and over again just so they can collect the fees. The VA noticed this was happening a few years ago. Lenders were calling veterans every 6 months. Hey, rates dropped 1/8 of a point. Let's refinance. The veteran would save maybe $20 a month, but the lender would make thousands in fees and the veteran's loan balance would keep going up. So the VA put some rules in place to protect you. These are called the net tangible benefit rules. We are going to dive deep into those rules in the next segment. We are also going to talk about the skip 2 payments myth and how to spot a scam offer from a mile away. But before we take a break, I want you to think about your current situation. Do you have a VA loan right now? What is your interest rate? Do you know off the top of your head? If you bought in 2023 or 2024, you might be sitting on a rate of 6, 7, maybe even 7.5%. If rates are trending down, you need to be ready. You need to understand this process so you can strike when the iron is hot. The market moves fast. When rates drop, lenders get flooded with applications. The queue gets long. The process slows down. If you know how the IRRRL works, you can be at the front of the line. You can have your paperwork ready. You can know exactly what questions to ask. Remember, the goal is not just a lower rate. The goal is financial freedom. The goal is cash flow. If you can free up $3, $4, or $500 a month, that changes your life. That changes your budget. Maybe that money goes toward paying off credit card debt. Maybe it goes into a college fund for your kids. Maybe it allows you to take that vacation you have been putting off. It is your money. You earned this benefit through your service. Do not let it go to waste because you are afraid of the paperwork or because you don't understand the process. The paperwork is minimal. The process is streamlined. The benefit is real. We have covered the basics. We have covered the why and the what. Now we are going to cover the how. We are going to get into the nitty-gritty of the requirements. We will talk about seasoning, how long you have to wait before you can refinance. We will talk about the recoupment period, and we will give you a checklist of exactly what to look for when you receive those offers in the mail. So let's start by talking about the guardrails. We need to talk about the rules that protect you and the traps you need to avoid. Let's start with the net tangible benefit. This is a rule the VA put in place to stop predatory lenders. Basically, the VA says that if you are going to refinance a veteran, there must be a real mathematical benefit to the veteran. You cannot just refinance them for the fun of it. Here are the specifics. First, the interest rate must drop. If you are moving from a fixed rate loan to a new fixed rate loan, the rate must drop by at least 0.5%. So, if you are at 7%, the new loan must be at 6.5% or lower. If you are moving from a fixed rate to an adjustable rate, the drop must be fully 2%. This prevents lenders from refinancing you for a tiny drop that doesn't actually save you money once you factor in the fees. Second, there is the recoupment period. This is the break-even point we discussed earlier. The VA requires that all the costs of the loan, fees, closing costs, everything, must be recouped by the monthly savings within 36 months. If it takes more than 36 months to break even, the VA will not guarantee the loan. This is a massive protection for you. It ensures that you aren't paying $5,000 in fees just to save $10 a month. The math has to work. However, you still need to check the math yourself. Just because a lender can do the loan doesn't mean it is the best move for you personally. Let's talk about another requirement: seasoning. You cannot just close on a house and refinance a month later. The VA requires that you have made at least 6 consecutive monthly payments on your current loan. Also, at least 210 days must have passed since your first payment was due. That is roughly 7 months. This is important to know if you just bought a home. You need to wait about 7 months before you are eligible for an IRRRL. So if rates crash 3 months after you buy, you have to be patient. Keep making those payments on time. Speaking of payments, you absolutely cannot have a 30-day late payment on your mortgage in the last 6 months. Since the IRRRL doesn't look at your credit score or your income in depth, the one thing they look at very closely is your mortgage history. If you have been late recently, you will likely be denied. You need a clean housing payment history. Now, I want to address a very common marketing tactic you will see: the skip 2 payments pitch. You will get a flyer in the mail. It will say, refinance now and skip 2 mortgage payments. Put cash in your pocket for the holidays. It sounds amazing. Who doesn't want to skip 2 months of bills? But here is the truth. You are not skipping anything. Interest accrues every single day you have a loan when you skip a payment during a refinance. What is actually happening is a timing trick. Let's say you close your new loan in November. Your new loan's first payment won't be due until January, so you don't pay in December. But the interest for November and December, it gets rolled into your loan payoff or your closing costs. You are still paying that interest. You are just paying it later over the next 30 years. There is no free lunch. I am not saying it is bad to have that break in cash flow. Sometimes having that cash in your pocket for a month or two is really helpful. Maybe you need it for repairs or to pay off a high-interest credit card. Just understand what is happening. Do not be fooled into thinking the bank is forgiving 2 months of debt. They are just moving it to the back of the line. Another trap to watch out for is the loan term extension. Imagine you have been paying on your 30-year mortgage for 5 years. You have 25 years left. You decide to do an IRRRL to lower your rate. The lender puts you into a new 30-year loan. Your payment drops significantly. Part of that drop is the lower rate, but part of that drop is because you just stretched your remaining balance back out over 30 years. You added 5 years of payments to your life. Is this bad? Not necessarily. It depends on your goals. If your goal is the lowest possible monthly payment right now because cash is tight, then extending the term is a valid strategy. But if your goal is to be debt-free by retirement, you need to be careful. Here's a pro tip. You can take the 30-year loan to get the lower required payment, but you can continue to pay extra principal to pay it off in 25 years. This gives you flexibility. If you have a tough month, you pay the lower amount. If you have a good month, you pay extra. The IRRRL gives you that choice. Let's shift gears and talk about the actual process. What should you do if you think an IRRRL is right for you? Step 1. Know your current numbers. Pull out your latest mortgage statement. Write down your interest rate. Write down your principal and interest payment. Do not look at the total payment with taxes and insurance, just the principal and interest. Step 2. Shop around. Do not just go with the lender who sent you the flyer. Do not just go with your current servicer. Rates vary between lenders. Fees vary between lenders. Call 3 lenders. Tell them, I am a veteran looking for a VA IRRRL. I want a loan estimate. I do not want my credit pulled yet. Wait, can you do that? Can you get a quote without a hard credit pull? For an IRRRL, yes, you should be able to get a very close estimate. Since credit score is less of a factor, they should be able to tell you their rate and their fees based on your estimated loan balance. Compare the APR, not just the interest rate. The APR includes the fees. It gives you a better picture of the true cost. Step 3. Calculate your break-even. Take the closing costs from the loan estimate. Divide by the monthly savings. Is it less than 36 months? Ideally, I like to see it less than 24 months. If you can get your money back in 2 years, that is a solid deal. Step 4. Check the term. Are they putting you back in a 30-year loan? Ask them to show you a 20-year or 15-year option. Sometimes you can lower your rate so much that you can switch to a 15-year loan and keep your payment almost the same. That is how you build wealth fast. Step 5, lock it in. If the numbers make sense, lock the rate. The closing process for an IRRL is fast. It can take as little as 2 to 3 weeks. Be responsive. Even though there is less paperwork, you still need to sign disclosures. You still need to provide proof of homeowner's insurance. Get it done. Now, I want to leave you with a thought about the big picture. Your home is likely your biggest asset. Your VA loan is likely your biggest liability. Managing that liability is a job. You are the CEO of your household. The IRRRL is a tool in your toolbox. It is not magic. It is a financial lever. When used correctly, it frees up cash. It reduces risk. It accelerates wealth building. When used poorly, it eats away at your equity and keeps you in debt longer. The difference between using it correctly and using it poorly is education. It is listening to podcasts like this. It is asking the hard questions. Do not be intimidated by the finance talk. You navigated the military. You navigated deployments. You can navigate a refinance. The VA IRRRL is one of the best benefits we have. It is the envy of the civilian world. Civilians wish they could refinance without an appraisal when their home value drops. They can't. You can. So keep an eye on the market. If you see rates ticking down, don't wait for the letter in the mail. Be proactive. Call your lender. Run the numbers. If you can save $300 a month with a 20-month break even, do it. Take that $300 and invest it, or pay down other debt. That is how you win. I hope this breakdown has been helpful. I hope it cleared up the mystery of the Earl. It is simple, but it is powerful. If you have questions, reach out to a vetted VA loan professional. Don't trust the spam mail. Trust people who educate you, not people who just sell to you. Thank you for your time today. Thank you for your service. Take control of your financial future, one decision at a time. And remember, as always, everything you want is on the other side of fear.